Hi, welcome to Stock Story. Today I'm on the third of a 7-part series of factors I look at when picking a stock, or really I'm actually picking a company. The stock price is what I'm trying to get a fair value from. So this is, like I say, it's the first of 2 videos on valuing a stock. In this one, we're going to talk about price ratios. You can divide the price of a share under a number of different value standards, such as book value, earnings, and cash flow. And you can do this, and you can look at certain, or you can set certain standards for yourself that you believe are good value. In the second series of these valuing or determining what's a fair price for a stock, we'll go into a discounted cash flow calculation, as well as a few other ones that help determine the price. This one's just going to basically look at the ratios and see whether they look fair or not. As I always do in this thing, I have to mention that this is for education and entertainment, is not financial advice. So please do your own due diligence before investing. Ideas here, or you can see what I've succeeded on, what I've failed on, and that might be a good starting point for you to look at what you actually want to do. So. Trying to do the. Okay, so I'm going to look at 2 stocks or 2 companies. One is Amazon, and the other one's Apple. Both right now are not buys for me. But I want to sort of demonstrate what the strengths and weaknesses of both companies are, and you can sort of see how we use these valuations. So, as I said, you can do price to earnings. So is the area that's shaded here, that PE stands for price to earnings. And you can look at this in a number of different ways. First of all, it is the price divided by the earnings, so it gives you a ratio. If I had a $100 share and I had $10 a share, it would be a price earnings of 10, which was very good. It's very well valued, and it's something that I'd start considering, or it'd be the starting grounds of looking deeper into a company. Of course, we've done the stuff that we talked about in our previous 2 videos. We've checked to make sure that there's good financial health and that the company is earning money and they're doing it in a pretty healthy way. So anyways, we get to this one, and the Amazon example here points out a few things. One of the things, like I said, in the $100 to $10 situation, where it's $10 earning to $100, it's a PE of 10. What that means is if you want to look at buying a stock as buying a piece of a business, and if you bought a stock where you're paying $100 for a share and you're getting $10 return each year, it would mean that in 10 years you would get back your investment, and that's what you're looking at. And so you cannot disregard this. I mean, a lot of times the stock market will jump because of growth, even though the valuations are out of whack. The problem is when the company can't continue the breakneck growth speed, what'll happen is that people who ran the price up will be very unforgiving and hammering it down. So anyways, let's look at this example here, and this is Amazon, and this is all off Gurufocus. I'll have links below, one on a review I have for the Gurufocus website, as well as a link to the Gurufocus website if you just want to take a look at it. So you see here in the shaded area that I have here where the cursor is, the PE for Amazon is 183.9, so basically 184. So that would mean if they weren't growing, that it would take 184 years for them to basically justify the valuation of their price. So right away, that's a red flag for me. That's something that would be very difficult to do, to be able to grow at a speed that would help make up that ground. Now you can see it's got a forward P, and that's an estimate. It's not actuals, it's an estimate. They're estimating next year what the earnings they figure will be with the growth rate of the Amazon, and they figure it'll be 72. So now you're looking at 72 years. Now the interesting thing is there's a third PE here, which is it takes out any unusual situations, and when you see that, it's at 183.99. So in this case, they didn't have any unusual revenues or expenses and that affected their earnings. So if we're to believe the estimates that people have for their earnings, then possibly next year it'd be 72. So it'd be a lot better value. And when you look over on this side, you see that there's a growth rate in the past of 41% for their earnings per share. Usually if something's got a high PE, I like it to have an earnings per share growth rate that's similar to the actual price earnings ratio. So this is just one of three, as I said. There's the price to book and price to cash flow. So anyways, when we look at the price to book, once again, it's very expensive. It's 21.5 times. So once again, the cash flows coming into the business are going to have to work really hard to get to the valuation. I'm not saying they won't. Amazon has been growing really well. They're doing a great job in a lot of ways. They've had inconsistent earnings, so I have not chosen to go in there. But the stock price has risen a lot because of those growth, people who jump in for growth. There's a big difference between growth investing and value investing, and this site is about value investing. There's also price to sales. I didn't mention that before, but that's the revenues. And here, Amazon's a lot closer to being what I'd consider fair value. If there's a price to sales of 2 or less, I feel that's pretty fair. This is the big one, though, the price to free cash flow right here. And you can see that actually their price to cash flow is quite good, and 45 is a lot closer to this. So they're not quite as bad, but they still concern me because their earnings have gone up and down at different times. And you can see the PEG, which is the PE factored in with the growth ratio, is 6. I want it to be 1 or less. So that gives me some issues with Amazon in this particular situation. Doesn't mean it's not a good company, but it just means I want to increase my chances of success, and I feel I get that if I get a good price. You cannot control the operations of the company. You cannot control a lot of things, but one thing you can control is the price you buy in at, and you can really, I believe I can really increase the chances will go up by buying it at a good value as opposed to a high value. High value, I think my risks are a lot higher. Anyways, moving forward, we'll look at Amazon, and this is where the company looks pretty good, is when I go down here. In the last 12 months, their free cash flow has grown at 54%. And that to me is important, because that means that actually their free cash flow to their growth is actually less than 1. So from that standpoint, Amazon is a lot more reasonably valued than I would think at the first thing. But I still think because of the high valuations off of earnings, there is some concerns. And you can see here that they've had negative, small positive. They've had a good past 12 months, but their long record hasn't necessarily been great. And it's a little mixed here. If you look at their last quarterly, if you multiplied that out by 4 for their earnings per share here, right in here, oh, I didn't know that was still on. Anyways, if you did that, you would get about $2, which is a lot less than the last year of $4. So those are reasons why I'm not necessarily jumping at Amazon. I think it's a very good company. It's got great growth. I'd love to see a market correction or something, make its price a lot more reasonable, and then I'd be thinking about going in. Okay, looking at another stock, let's look at Apple. And Apple is another situation. Apple is, it's got some good valuations, but it's got some concerns with its growth right now. So if you take a look here, the price earnings ratio here is pretty good at 14.5. And so as a result, when you take a look at their earnings per share growth, it's fairly close. So their price to earnings, which is down here, is three is a lot cheaper. So right now this looks pretty good. Price to book isn't quite as good. It's closer to what Amazon was, a 5. I was owning Apple. I still own a little bit, but I've sold off quite a bit as the price has gone up. The valuation has been harder to justify, especially with the slowing earnings and free cash flow. I'm holding a bit of it. I'll check and see how their next earnings are. If their growth comes back, then I might start adding to my position again. If they continue to disappoint with their earnings, then I'll probably sell off the last bit of it. So anyways, looking at it though, you see that the price earnings is 14.5. Forward PE, once again, the growth expectations aren't as high. So they're looking at a little under 13.5. So I guess what this means is they're not growing dynamically, but it would be less than 15 years for the earnings that they currently have to return your investment. So the return on equity is pretty strong on this particular company. The other thing is the price to book is a bit on the high side. So if their earnings start going down, then that's a bit of an issue. That being said, one of the things about Apple is it's a cash flow machine. It earns more money than any other company in the United States. It slowed down, but at one point it was 3 times what Google is, which is the second highest market cap to Apple. So there's a lot of cash coming in. It's paying a dividend. There's a lot of strong points to it. It's just a concern that they don't seem to be innovating as much now. So these are some of the decisions that you make. Right now, this looks like a pretty good value, but as you'll see when I go to the next sheet and show you how the earnings is reducing, it does have an impact on how strongly I feel about the actual value of the company. So you see the price earnings to growth, and actually I probably made a mistake on the Amazon side, but the price earnings to growth here is 0.76. I got to get it above where my picture is. When we go back to the one for, go back to the one for Amazon, you can see that, the price earnings to growth is coming back here. The price earnings to growth here is 6. So it's quite overvalued based on the PEG ratios. That being said, though, it does have growth as we saw in the other thing and in the other screen, and that's a good thing. Now we look at Apple's growth situation, and we see that on all ends they seem to be reducing, especially right here with their free cash flow went down 21%. Now, one of the things is they're coming down from a very high place. So I don't want to totally get out of the stock completely, because at the end of 2015, they had a blowout year that was just phenomenal. It made so much money, and in comparison to any other company, they made so much money. So we're coming down from this is the last 12 months. So it's coming down from what was like a record earnings for any U.S. company. So don't want to be totally hard on it. But as I look down here, if I were to take a look at things like their free cash flow, it's going to, if it stays at these rates here, it's going to end up being about 880 880. So it's going to be coming down again from the past year, which came down again from the previous year. So as you can see, we're going in the wrong direction. That still doesn't mean that they're not growing their book value, because they're still earning a lot of money. It's still going into the balance sheet and increasing their book value. So Apple is still, it's closer for me than Amazon, because it is it's cheaper to its earnings. It's making lots of money, so it's going to grow its book value. So there's a lot of things that are still good, but I have trimmed my position to take some of the gains I had, because I did buy back in the when the CEO changed from Steve Jobs to Tim Cook. So the price has gone up a lot. So I've taken a lot of my gains because of this slowing. But I'm keeping some in, and I'm going to add position if they start to show that they're at least not going to keep shrinking. So that's pretty much what I do. So I look at these things. When we get to the next video, we're actually going to look at how we look at ways to set prices for a company, what we think should be a fair value, or whether it's trading at a discount. These ratios give you a quick snapshot and idea of it. In the next one, we're going to do the discounted cash flow and look at some various ways of valuing a stock and what the amount would be. So, as I said, in the Stock Story website, you can see the article that covers all this information. It goes into a little bit more detail. It is a little bit older, though. It has Apple back when Apple was a super value for buying. So some of the discussion is a little bit different. But as I said, the next video that we do is going to have discounted cash flow. It's going to have various ways to determine a price that would be fair to buy in, and we'll look at that. So please, if you like these videos, please subscribe and like it. Love to see your comments. I know that I bounced around a little bit here, and I'm trying to improve this process, but I'm looking forward to getting all this information out to you. As I said before, there'll be links to Stock Story, as well as to Gurufocus, and as well to a review on Gurufocus, where I get a lot of the information that I want on value. Gurufocus is a website that is truly valued or truly focused on value investing. So anyways, have a great day.